Hello and welcome to this special edition of Editors Roundtable. Usually this is a wrap of the week and we are winding down, getting ready for the weekend. This week is obviously very, very different because we are fully charged up and fully warmed up ahead of the big event tomorrow, which is the Union Budget 2025. Well, as always, I have a full house with me. Of course, there's Prashant, Nigel and Nimesh, but we have a very special guest joining in. Someone who's been a big investor in this market for years, for decades, and someone who kind of flagged off a bit of the caution in the market in terms of the elevated valuations, quality of stocks and companies, and just, the exuberance many months ahead of the curve, might I say. Siddharth Bhaiya, fabulous to have you with us on Editors Roundtable today.
Hi, Nigel. Hi, Prashant.
Good to have you, Sid. How are you feeling now about the markets? You were cautious.
Yeah.
Tell us the top 3 reasons you were cautious about, and have any of them moved to those levels where you believe you'll not be as cautious as you were the last time we spoke?
Yeah, thanks, Nigel. Hi, everyone. So I think we first became cautious around July, August on the markets, right? June, July, August, around that time. And our cautiousness primarily stemmed from the fact that valuations were absurdly high, right? Like as high as I've ever seen. Like, I'll give you context that people used to talk about Nifty P being 25 or 26 or whatever, or the Nifty 500 P being like 27, 28. But, you have to understand this, that in Nifty 500, of the top 50 companies, okay, they contribute 70% of the profits. And they are available at 16p. The rest, 90% of the stock, the average P multiple is 36. Everybody talked about Nifty being 25, 26, but their portfolios were all 40, 50, 60p multiple. The small cap index was quoting at 40p multiple. The mid cap index was at 45p multiple. And when you're talking about an index being at 45p multiples, then a lot of stocks are at much higher this. So I think today, even today, more than 500 stocks, which have a market cap of more than 500 crores, have a P multiple of more than 100 and a price to book of more than 10. So our first these are valuations that I've never seen, even during 2008, right? And we've got data, 2008, the mid cap and small cap P multiple was 30.
Okay.
And here you had valuations which are 50% higher.
Can we, can we take it one by one? So let's delve into valuations a little bit. I have 2 points. One, haven't valuations now been, I don't know the answer, I don't think anyone knows the answer, but I wanted your thoughts. Have you seen a step up in valuation bands itself? Because if you take a look at, so you said 2008, what is 20, maybe what is 40 is the old 20, I don't know. Has something, a step change happened?
So
that is
does
one.
this work in the market? The whole point is...
Prashant, you're using those 4 dangerous words. This time it's different.
No, I'm not saying that. All I'm saying is, have we moved higher in terms of valuation bands? Because valuations actually, for example, lots of people say that from the highs, markets have corrected quite a bit. But they were very high. They've just become high now. But is 60 times okay after falling from 100 times? I don't know. So that is one. And second is, you said that the proportion of the companies, large company P multiples are small. But isn't P based on rates of growth? Who's growing how fast?
Second,
so,
good point. So first we came to valuations, right? See, you have to understand the markets are far older than the last 10, 15, 20 years. Markets have been around for 500 years. Right? When there was a crash in the US in 1928, there was a depression even in India. Stocks tanked even in India. So remember, the global economy that time was correlated. So this time, so valuations are stretched by any, are very stretched by any historical this. And they said this is 4 years back where nobody wanted to touch small and mid caps. I have bought stocks in March 2020 at, below cash. So let us not say that, we going toward this. Now coming to growth. The argument in June, July was, India is a growth market. Growth is phenomenal, the P is justified. That doesn't mean that you can justify any P multiple, but what happened after that? Growth has actually collapsed in India. Right? We just did this analysis. More than 500 companies have reported their results till now for the quarter. Do you know what is the top line growth and bottom line growth?
I think it's minus 5%.
It's 4% top line growth and close to 3% PAT growth. This is for the companies that have reported. US growth rate has been far better than that. A lot of European countries have reported better growth.
But
so Surbhi, I don't have the data, but amongst the top 10 economies, ours will be the slowest growth rate this quarter.
No, there's no taking away from that, and we can't debate or argue against those numbers. They're hard facts, right? But a large part of the market, Siddharth, wants to believe that this is a short-term phenomena. We've kind of wound ourselves in this funk. It'll sort itself out. So the narrative throughout brokerage notes, if you read them, is second half is going to be better. And it's pegged on two, hopes. One is that government ko to spend karna hi karna hai. Government capex has to pick up. And the second hope is that thoda bahut income tax here and there, we get something, and consumption will revive.
So we'll come to the second part of government capex later on. First, we'll answer this. One, market doesn't work on hope. Market works on reality. You can't be a bull or you can't be a bear. You have to be right. Right? And we got pillared in the last 3 months by a lot of people on social media saying you guys are bear or you're bearish or the mandodi. Look, we made the most money in the previous 4 years. Right? March 31st, our 5-year CAGR was 53%. I don't remember, it could be some of this. And I said, these returns are not sustainable. You've made what people make in fixed deposits in 70, 80 years, you've made in 5 years. What you're supposed to make in the stock market in 15 years, you've made in 5 years. I said, better to take that money home, right?
Enjoy the
cash in the balance sheet is what you own. Cash, your stock markets, can
Notional.
get this. Right?
What is the cash you all are sitting on as of now, as a percentage?
Oh, it's gone up from the last time we spoke, so it's much higher.
So what is it?
We're more than 90% now.
Wow.
In cash.
In cash.
So you're clearly cautious on the markets.
Very cautious.
Actually, just an anecdote. Nimesh, it's your question. I just if you remember, Siddharth was with us on the day of the budget.
Yes.
It was around 2:30, and everybody was,
Hearing and
and Siddharth really, put the cat among the pigeons, and there was a sannata for a while.
I know.
Yeah.
But I think so. You were absolutely.
So, and we mentioned a very important point that day.
Yeah.
We said, the government doesn't, and we'll answer that question on capex as well, that it doesn't have an absolute majority. The first 10 years, there was a lot of focus on development. The moment you have a fractured majority anywhere in the world, not just India, the moment you have a coalition government, you go on to freebies. You go on to welfare schemes. We pointed out very clearly in this that the focus will go towards welfare schemes. You saw that with Maharashtra. You're seeing that in
other states as well.
In the other states, you saw that a lot of the budget went towards Bihar and Andhra. So, as I said, what the government says and what it does is more important. So I hear a lot of this saying the government is not spent, but the government doesn't have money. Government balances with RBI is only 67,000 crores when I last saw it. So it's not like the government has the money and it's keeping it. The government doesn't have the money. So before this, a year back, everybody was talking about capex, but there's no money to do the capex. And you've had a fantastic year as far as tax collections are concerned. Right?
That's thanks to capital markets. No?
Capital markets,
that's been
right?
the biggest contributor
And
of
personal income tax. Let's not forget personal
A lot of
income
people
tax.
have paid a lot of capital gains. It's not going to be there next year.
But Siddharth, when I was chatting with you off the record, you had a very interesting point on the slowdown as well. You believe that it's capital market driven slowdown. If you can just share your rationale there.
So, Nimesh, the capital market has to be an outcome of the economy. If the economy does well, the stock market has to do well.
Correct.
In India, the narrative was stock markets. Everybody wants an interest rate cut. Why? Because the stock should go up. Nobody cares a damn about the economy.
It's the Wall Streetization of Dalal Street, is it?
As I said, Wall Street is a different thing. We'll discuss that. So, means I don't.
Let me ask you this. So your cash is 80%?
90%.
More than 90%.
More than, okay. But is the cash level for viewers who are watching, right? They do SIPs and they are. So what should they do? I mean, everybody, they can give you money, but not all, right? And you'll.
We're not taking money, Prashant, for the last 6 months.
Okay, so that's also closed. So they can't top. You can't top sort of tops and bottoms. So my question is your cash level a reflection of your of the fact that you find other things more expensive, or you see significant downside here? Because it's possible markets stay here, others do better. Is that what the call is?
No.
Or
So clearly, as far as
here?
Indian stock markets go, they're terribly expensive. When I'm telling you, 90% of the companies in the Nifty 500 have a PE multiple of 36, right? Where there is no absolute profit growth. And I'm not even going to the small and mid caps, which are far more expensive, right? So on an absolute thing, and as you said, see, this is something which will play out over 18 months or 24 months, you know. Bear markets don't end in... So there are going to be a lot of short covering rallies, and that day people are going to curse me, saying he was wrong.
But you think that this is a proper bear market that has to play out?
So, Surabhi, we discussed valuations.
Correct.
We discussed growth, which is collapsing right now, right, across this. So much of the domestic wealth is tied to the stock markets. I'm really surprised that so many people have called me that we've lost so much money.
Yeah.
And
Only
I said,
in 3 months.
In three,
Only in
1
3
month.
In 1 month, yeah.
Right? 1 month is basically where people have lost so much money. And as he said, 1 month of a bear market is equal to 1 year of bull market. 1 year of a bear market takes away 5 years of bull market.
Yeah.
We've all seen that in 2009.
Yes.
So when you say this will play out in 18 to 24 months, you're saying a period of no returns, or you see...
It'll be a combination. It'll go down, it'll come back, it'll go down, it'll come back. There'll be stagnancy, right? As I said, you know, I can be wrong. This is how I see it. I draw parallels from 2007-8. I look at the valuations at that point in time. I look at the excesses at that point in time, whether it is the IPO, whether it is the, QIPs, everything.
Yeah.
And then I see that this market has been at a much higher, the bubble is much bigger than what it was in 2008.
All right, but Sid, what will make you, personally, I'm keeping my SIPs going. I'm putting it for the longer term, and that's my view about it. But what will make you turn this cautious view that you have?
So again, as I said,
you're being cautious. You're sitting on a lot of cash as well, and in the last few years, some of those stocks for you have gone up 7, 8, 9, 10 times as well. So good amount of money.
Yes.
But what will make you start, again deploying some money, levels or a particular trigger or something?
So, and it's there, this has been our philosophy for the last 10 years, is do as the promoters do.
And promoters sell, you sell.
And they've been selling.
Promoters buy, you buy.
By 2020, every single company in my portfolio, the promoters were massively doing buybacks.
Yeah.
Right? Nigel, who the guys who've sold in the last 18 months?
A lot of promoters.
Promoters,
Promoters.
early stage investors.
Right?
First they had the story and the investors.
Now we're holding the story.
investors
As mutual fund
But tell us,
investors.
make that point.
So, FIs have sold nearly $50 billion in the last 18 months. And the promoters, through QIPs, IPOs, FPIs, everything, have sold another $50 billion. That's $100 billion. Who's bought it?
We have. We are holding mutual funds.
Quite brave of you to say that you have, but yeah.
No, it's my domestic mutual fund. I'm not saying me.
It is the retail directly and indirectly. Right?
Yeah.
Where's your SIP gone? To the promoters.
Yeah.
Through the QIPs, through this. It will come out. All these things will come out at some point in time as to what was the due diligence that went into buying $1 billion QIP, and how much time did you actually spend? We spent 3 months researching a stock before we buy 100 shares.
Yeah.
In a bull market, 3 month stock is... so it's...
As I said. So, and if you had no shares, what made you all of a sudden buy $1 billion worth of stock? So there are a lot of excesses, right? I don't even want to venture into the SME space, which was a casino, right? Too many excesses.
Yeah.
So
That needs to
we'll figure out. We'll figure out. We'll see how this unravels. I hope I'm wrong, right? Because
No, absolutely take that point. And I think for mutual fund managers, we've seen that period where they were being, loaded with so much cash on a monthly basis, still are being, that, I mean, at some level they had to start deploying.
And the argument that I get is, oh, we don't have an option. Of course you have an option. You can stop taking money.
Yeah.
Oh, yes.
Of course you have an
Take the
option,
high road.
right?
Yeah.
This is, you're doing a fiduciary job.
That's
You can stop taking money. You can stop launching all the riskiest types of, NFOs.
Oh my goodness. Don't even
At
get
the
me
peak
started.
of the valuation.
Yeah.
So let's not discuss that.
No, really, but I'm glad you brought this point up because it's a fact. It's something that we as, commentators on the market, we've seen that. The NFOs that came in on thematic funds, on sector funds, on momentum-based ETFs, right? So questions will be asked. Anyway, we have to take a very quick break. Back, and the conversation continues in just a small while.
Welcome back. You're tuned into Editors Roundtable, and we are in conversation with Siddharth Bhaiya. Well, Siddharth, you're sounding fairly cautious, but the other big argument we have is India is, on its way. It's marching ahead. Growth is going to be back, which obviously you put out a couple of data points as well, and we're up to a multi-trillion-dollar economy. But there's this debate, this raging debate, India versus China. And you had launched that fund where you were talking about China being at attractive levels a few months ago or so. Well, how do things stack up right now? China suddenly seems to be coming back to life.
Yeah. So in fact, the Chinese markets last year outperformed the Nifty.
Yeah.
Right. And in fact, in the global rout post DeepSeek, it is only the Chinese stocks and Hong Kong stocks which have gone up. Right. So couple of things. One is what you have to understand is in the long run, the economic growth or the GDP growth translates into stock market growth. If you look at a 70-year, 80-year horizon, our nominal GDP growth is equal to our money supply growth is equal to the rate at which the stocks have returned. But Nigel, I grew up in the 90s, right? 1991, the Sensex was at 4,200. 2001, a decade later, the Sensex was at 2,800.
Yeah.
And 70% of the companies which were there in the Sensex in 1991 were not there in 2001.
Correct.
And it was a decade of massive innovations. And great companies that came, HDFC Bank, ICICI Bank in the new avatar, Bharti Airtel, Sun Pharma, IPCA, TCS, Infosys, Wipro, all the nifty companies today. But that did not necessarily translate into this. So, to me, my bigger concern is, yes, over the next 10 years, as a country, we are going to do really well. Okay, we've all the groundwork which is necessary for us to do economically well. But that does not necessarily mean that it will lead to return. A lot of that growth is already priced in. We've, 2047 is already priced into the stock markets. So one part is that is my disconnect. People say, oh, you're bearish. No, I'm not bearish. I stay here. I pay my taxes, right? I pay and I bring up my kids here. So I'm very bullish as far as our country is concerned. We're a strong democracy. Everything is in place. The problem is with the stock market. Okay. Second, coming to China, right? They said, China is a $19 trillion economy. We are a $3 trillion economy. Slightly more than that. MSCI weightage for India had become higher than MSCI weightage for China. Now, how is that even possible? You're getting, I'll give you an example. Meituan in China, okay, it's similar to Zomato, is available at 15 P multiple. It was founded much after Zomato, and it's grown at a much faster pace. And it's a much bigger company. It's probably 7 times the size of Zomato. And we all know what the P multiple for Zomato is. Yeah. I don't even know. Means it's I don't even bother.
So China is clearly cheap, much cheaper. That is true. You like gold as well, Siddharth,
Yes.
right? So for our viewers, I think that's another area of interest. What are you thinking, and where will gold head from here?
Okay, so I'd done a presentation on gold in 2021 when gold was at 47,000 or something, and I said gold is a great asset class to own. Okay, 2001, 2009, COVID, all days when your portfolio is bleeding, gold is actually up. Okay, there are few things about gold, which one, gold is not endemic to the earth. Gold came to earth through a meteorite. Okay, all the gold that has been mined till date can be stored in a 25 by 25 by 25 square cube building. Okay. At the same time, gold is the only standard. Gold doesn't have an half-life. A kg of gold will remain a kg of gold 1 million years down the line. It's very ductile. It's very malleable. If you draw a string, which is
You're
1 mm.
making me fall in love with the actual
when
stuff.
when you read the facts, okay? So you can't mine, you cannot, for thousands of years, people have spent time trying to make gold.
I think the annual rate of production increase is about 1.5%, right? Nothing.
Right. Again, come to a country like India. If you have a financial fraud against you, do you think you can recover your money back? And which has always been the case, right? You still have Ponzi schemes in Bombay, the latest jewelry scam that we had. So for an housewife, for somebody who's, semi-literate, that's their only source of wealth.
Yeah.
Right? And it's a great hedge against currency depreciation. Imagine if you were in Sri Lanka or Nepal or Bangladesh or any of those countries where your currencies just tanked. It is only the price of gold that went up immediately.
So how do we play this gold theme? The sovereign gold bonds, that's not come about. But gold Bs?
Gold ETF, yes.
ETFs
Yes.
and
So
funds.
we've
But in the price itself, is that $2,800? Do you have a figure
it just
in
made a
mind?
new lifetime high yesterday.
Yeah. So where is it headed, you think?
Prashant, you'll be surprised to know that since 2000, gold has outperformed the S&P 500. For all the Microsoft, Amazon, gold has actually done well. It's in dollar terms. It's outperformed the Nifty in INR terms.
Since we're having this discussion across asset classes, obviously listed equities, you still have a lot of concerns out there. I don't know if you're looking at the unlisted space, because that suddenly started getting very hot. It was a sign of sort of, exuberance and euphoria as well. But the IPOs that have come in, and there have been many in, throughout 2024, right? And some of them are new businesses which weren't listed before. Now, whether it's it's a different debate. Solar cells, whether they'll go out of fashion because there's oversupply, separate debate. Or, whether companies like Sagility, etc. Absolutely new businesses. Has anything caught your attention or imagination, either recent IPOs or
So I was
soon
just
to be
discussing
listed
with
companies?
Nimish before this. He said, I have not applied to an IPO in 3 years. I said, I have not applied to an IPO in 25 years.
Oh my God, okay. The wrong question. So that's what I'm saying. That
No, so I'll tell you, Surbhi, do you know that between 1991 and 1995, there were more than 5,000 IPOs in India? Okay?
Okay.
And out of those 5,000 IPOs, today the listed stocks itself are 6,000. After that, a lot of IPOs came. Before that, there were a lot of listed companies. 9 out of 10 companies in India eventually delist over a period of time. Okay? IPOs, to me, become a gambling game where people just apply for listing gains and then sell it. So if you're treating it as a casino, then don't come and blame the stock markets later on if you lose money. Right? So, and coming to innovation, we've always been innovating. We kind of feel that we are innovating, but everything here, this camera, everything is an innovation. We tend to just underappreciate it.
Let me pull you back to large caps as a category, because you began by saying that large caps maybe. Does that segment have value, you think?
So, amongst the top 50 companies that I mentioned, okay, 25 of them are PSUs, which are by historical metrics quoting at a much higher P multiple than their historical this, right? A big segment of that is banks. And everybody's been bullish on banks for the last 1 year, and I've been telling banks will not do well. And banks have actually underperformed throughout this. For the simple reason, Prashant, last 15 years, we've not seen what an NPA cycle is. The last NPAs arose in 2007-8, got cleaned up in 2015-16, right?
But that was more of corporate NPAs. Now the corporate balance sheets are quite strong, right?
Precisely the point, Nimish. But the pain is on the consumer side.
Sure.
The pain is on the consumer side. The corporate lending is... So Nimish, this time there's not going to be any NPA. There's going to be equity. There is going to be NPA in the equity book.
But you know, historically we've seen the retail NPAs doesn't seem to be that bad as what the corporate NPA is to be, right? I mean, obviously we've not seen the history of retail NPA going belly up and not paying up, but still, you know, at least the corporate balance sheet is good. So from that perspective, don't you think bank makes a good point to enter?
Never before have we had retail lending like this as well. 15 years of, MFIs and NBFCs and this we've not seen for 15 years.
But we've had periodic busts, right? I mean, IL&FS happened 2018. We've had, the entire cycle, DHFL.
See, IL&FS was more again infrastructure.
It's all
it had got nothing to do with
retail. We've not seen a down cycle and how that looks like and feels like.
Right, and
we are seeing the accident now in MFIs, right? Credit access, all the stocks.
But MFI is supposed to have an NPA cycle every 10 years.
Yeah,
right? I mean, that's the nature of the business.
But people forgot, right? That is why they otherwise, why would you give 10 times price to book for the MFIs?
Right. So just to complete that point on large caps, what's the view? I mean,
what's the view? Again, as I said, large caps would be a hiding place. Okay. People said, as you said, Nifty went from 20,000 to 25, 26,000, whatever. Stocks went up 100%, 200%, 300%. Nifty is back to 23,000 and you've seen the damage. If Nifty goes to 20,000, you can imagine what the damage on the rest of the portfolio.
But where to hide, Siddharth? Where to hide?
Gold.
From the large caps.
Let me ask.
No, from the large caps. Gold we got.
See, as I said, I've never been a large cap investor, so I don't want to, go about. I'm just putting out the analysis for you.
So let me ask that question in a different manner. Your point on valuation is well taken. I mean, you don't like much in the market. You're sitting on 90% cash. But which could be the pockets, whether mid-cap or large-cap, wherever, where valuations would kind of somewhere come, not right now, that might not be the case right now, but maybe as things progress, where you find realistic valuations with decent growth. Let's not compare with China. Now, China's a different story. I mean,
Look at the European markets, right? First, you have to understand valuations in the global context as well, right? US banks have had a record quarter of profit growth. Why wouldn't anyone in the global FII in their right mind buy, HDFC Bank over a JP Morgan or a Citigroup or a Goldman Sachs? When HDFC Bank, for the next 4 quarters, growth is not going to be there. Right? So to all those people who are saying we're going to punish the FIIs, we're going to force them to buy higher. Look, guys, you're 3% of the global GDP. Right? For the FII, India doesn't matter. It does, means, and those are the guys who've been investing since 1991. They have made money in India over the last
30 years,
35 years. We're telling them that we know.
No, and now they've sold because we've given them the exit. Otherwise, they would not sold. I mean, just because there's so much of domestic liquidity which is helping them to exit, they're happily exiting.
They've made so much money on option trading.
Yeah, absolutely.
They've made so much money on option trading.
That is another topic which is very close to your heart, but we've not found time to address that. So I hope you come back.
Yes.
For
Look forward to more of these.
Thank you very much.
Thank you.
Thank you, sir. Thank you.
All right, thanks so much. And with that, it's curtains on this extremely interesting conversation. Thank you for watching.